Now, let's just first of all give you my insight about a lot of these markets. For gold and silver, I've mentioned before, I wouldn't be too surprised if we see a bounce to $26 or maybe even $30. And although I do see some bullish aspects on the way, I am not as bullish as a lot of these experts like Maloney, Faber, Schiff, Greg Hunter, Duane, a lot of these people out there. To understand, a lot of these people are just salesmen. They exaggerate their claims. They just want to scare you, add fear, get you all energized. And I don't find them as any as more or less reliable as CNBC, Wall Street Journal, and a lot of these other people who have been hacking people for years. I gotta tell you. Really, you gotta wake up and get some outside information. I wouldn't be too surprised if fall, the precious metals continue to tank, and we see this continue for 2014. As for bonds, I do see some friction along the way. We have seen the rates gone up. Bond markets have been going kind of in the same direction for the last 30 to 35 years. So it's got to turn around sometime. It can't go in the same direction on and on and on. It wouldn't be something that I would really want to get in. Real estate, as a matter of fact, I mentioned about a year ago, I wouldn't be too surprised to see real estate go up 15%. In my neighborhood, it went up 20%. I was a little bit off. Well, I guess nothing in terms of our forecast can be perfect. But anyway, looking into that, I do believe that rising mortgage rates are going to cause friction. Rising interest rates may come along the way, so I wouldn't be too optimistic about that, certainly. And not to mention, the job market isn't as great as it used to be back in 2005 to 2006. That's another thing you have to understand. So, would I be too optimistic as I was 7-8 years ago? I don't think so. And I wouldn't be too surprised if it doesn't perform as well as the previous housing boom. Now, something that I'm more optimistic about is, of course, the equity markets, a lot of the indices. Now, when you look at patterns, you see that markets have bull runs for about 5 years, 1982 to 1987, 1995 to 2000, 2002 to 2007, and then we started this bull run in 2009, so 5 more years is 2014. Alright? So I wouldn't be too surprised if we see a crash or a certain level of correction in that year. Now, usually with these predictions, they may come a year off, because a lot of people predicted that the markets are going to really crash in 2007. In fact, they dipped in late 2007, but they really began to accelerate in 2008. So we can see this thing accelerate in 2015. I wouldn't be too surprised if we see a kind of a correction in spring of this year. Usually markets don't correct during the summer, so you don't have to add a lot of fear. Now, it did correct in August of 2011 in the Dow Jones, and that was quite obvious because we were having the debt ceiling, bond downgrades, but I don't really see that for June, July, and August. One thing you have to understand, the price-earnings ratio for a lot of these companies, many of them are still low, particularly Yahoo and Ford. The 200-day moving average still looks pretty bright. You have to understand, on the other hand, there's a lot of analysts that you see on Yahoo Finance and CNBC that keep mentioning, oh, the market needs to correct, this bull run was fake, and they kept mentioning this on and on. April, March, February, last month, this month, next month, few months from now. Come on, you guys are hardly ever reliable. Don't really trust so much on these folks. And then the ones that they tell you that's going to go up, they may parrot the same thing over again for about 2 more years, and then a month or 2 later, the thing crashes. And then that's when you lose your you-know-what, when you get slaughtered like sheep. So don't really buy into so much of what they tell you. It's better if we do our own research. So I do see some bullish opportunities ahead, but again, it's not really easy. I cannot be very accurate about when this thing is finally going to correct. I believe the main reason that markets are going higher is because of growing earnings, as a matter of fact. And yes, some of it is because, okay, more dollars are pumped in, very low interest rates, but I don't believe as much as what you keep hearing from Faber and Schiff and a lot of these other people. Alright, stay tuned right now. I'm going to show you some charts and I'm going to give you my insight. Thank you so much. Hello everyone. I want to start off by giving you a precious metals update, something that you won't hear or hardly ever hear in the establishment or even the alternative media. I want to show you sort of my track record. I want to let you know whether the things I forecast were quite reliable. As you can see here, I had a chart of silver that was made around May of 29th of this year. I stated that there is a good possibility that we were going to either touch the teens, the upper teens, or we were going to go quite higher into the 20s. Now, a lot of people kept telling you it's a very, very good chance that it's a buying opportunity, it's going to go higher, continue stacking. Well, I wasn't as optimistic, and as a result, it seemed that it was a better idea not to be so optimistic about a spike higher, and as a result, we went from $22, I think we traded below $18, and now we're hovering at around the upper $19 range. So it looks like to me that a lot of these support lines delivered a lot of reliable analysis. One of the important things you have to understand, though, is that where are we headed in the future? Now, right now we're trading around 1950. It's very important for us to see if we break above 20. So if that happens, we can hopefully touch 22 and maybe even 30. If not, there's a possibility that we can touch the $16 range, like we've touched several times at around 2007 and even way back in 2009 and 2010. So this is something that you really, really have to look forward to. And again, I think silver has been smacked down so much, it wouldn't surprise me if we have a rebound. Again, on the other hand, it wouldn't even surprise me if we would be lower than where we are 365 days from now. So I'm showing you my previous video. I just want to let you know whether you find this quite reliable or not. This is the Dow Jones. As I've told you before, I believe that there are still lots of opportunities in the non-commodity related equity markets. As you can see here, it seemed like we have plunged over the news that there's going to be less monetization and stimulus, but it seems like we've rebounded over claims that basically the worries has eased quite a bit. I have told you this before. I believe one of the main reasons why the equity markets are rising is because of earnings. It doesn't have to do a whole lot with stimulus, or as much as what a lot of these individuals like Peter Schiff and Mike Maloney keep parroting about. As for the markets, usually during the summer months it isn't as volatile, with the exception of August of 2011, which was obvious because we had a debt ceiling, a downgrade of the treasuries. But for the summer months, I am looking for a scenario that it's going to be in a situation where we're not going to crash horribly. We're just going to be quite stable. Yet there are opportunities that you can trade this, continue to buy low, sell high. As for the summer months, there is a good chance that we could see a correction, because we've seen a correction somewhere in the fall months in 2012. We've seen it in 2011. So after seeing this continuous rise over time, it wouldn't surprise me if we see one. Now, when is this rally going to finally stop? Because we have been bullish for 2009, 2010, 2011, 2012, and most likely we're going to be bullish for 2013. Well, as history has proven, we usually have bull runs every 5 years or so. So let's just take a look. As you can see here, we have bull runs every 5 years. Let's look at the bond rates. As a matter of fact, you can see that they have been creeping higher. You can see how mortgage rates have been creeping higher. In some cases, they have increased by 40 to 50%. So I think there's going to be a lot of conflicts. People think that the bond market is necessarily going to be horrible for equities. That doesn't necessarily have to mean the case, because a lot of people can argue, well, people can pull their funds out of bonds and they can put it into equities. So it can be more bullish than ever. You can see here how the currencies for the US dollar isn't looking so terribly. You can see here how it has done quite well compared to the euro, the pound, and didn't do so horribly compared to the Japanese yen. I know this was in the triple digit, but it didn't fall as much as I expected. So looks like the so-called dollar bears didn't turn out as right as they're supposed to be, as a matter of fact. Now, I have been profiting recently. Let me show you what I have been getting into. One of the things I do, and you guys are going to disagree with me this, you guys are going to think I'm nuts, I'm out of my mind, but one of the things I do is I buy companies before the earnings date. That's right. And people tell me, well, when you buy companies before earnings date, they're so risky, it's like gambling, you don't know what you get into. Well, you have to do some research. You have to look at past results. You have to look at fundamentals, key statistics, in order to have a very good chance that the company is going to spike during earnings report. Let me show you some companies that I got into that did very well. One was KB Home, as you can see here. Let's take a look at the 1 month chart. As you can see here, I sold KB Home at the 27th of 2013, as you can see here. Now, it was down for the day, yes. The volume was very high, but I was able to sell it at around 2050. So in other words, I made a 3% profit. So just because it goes down for the day doesn't mean it's down for the entire day. So let me show you some other companies. Lennar, another home builder. So let's take a look. I'm going to show you where I got in. This was another company, Lennar. I believe, yes, I sold it at around 36.50 or something. And this was around its earnings day. It was down for the day, but it was very positive for the rest of the trading hours, as a matter of fact. So I was able to click in to a 3% profit. And this was during its earnings day. Now, this was a company that I bought a while ago, Oracle, that didn't do so well. So I don't always do very well during earnings reports, but I still believe I have a good chance of succeeding. This was the one I got into, Oracle. This was during the earnings report, and it plunged about 8%. Didn't do very well. Here's another company I got into, Adobe Systems. Look it up. Okay. So it's doing very good for the day. Let me show you when I sold. Yes. I sold it around here. It was about 46-ish. That's where I got out. But as you can see here, it went up tremendously during the earnings days. And it may have been a situation where it's fallen, but usually I sell during the beginning of the day. Now, it depends on the markets in general. For an example, the company may start going up during the beginning of the earnings report's day, or on the day that it moves right after the earnings report is reported. But the reason it might come down later on is because the general markets, for example, Dow Jones, NASDAQ, is going down. So then you can see how people are liquidating, they're selling off because there's a force coming from other factors. So that's why it can come down later in the day. But you can see this great increase in stock prices in just one day. The volume was very high. The relative strength indicator went very high as well. Here's another company I got into, Ross Stores. Okay, as you can see here, let me show you. Okay, I can't remember what day it was. I don't remember exactly. I think it was the 24th. Let me take a look. Yes, I believe it was the 24th where it reported its earnings. It didn't go up as much, but I was still able to lock in for a profit. Now, if it don't go up so much, there's going to be a problem because your commissions are going to be so high, you really can't profit as much. So this is another thing you have to look into. Because some people tell me, well, don't buy so many shares, but the problem is that if you don't and stock goes up like 0.5%, you really can't profit as well. And that's the thing about gold and silver, physical, is that the commissions are not low enough for you to trade successfully as well as equities or ETFs. That's one of the problems with precious metals, because I think some people were charging 8% over spot for trading physical gold. I mean, how can you trade that? With gold, in many cases, you do have to trade. You just don't hold it. I mean, you could, but normally you can do better if you trade gold. And that's the same for equities as well. So this is something I want to tell you. I want to show you my success. I have been getting out more often in the precious metals bubble, especially in the last few months or so. There has been no time at all where I have been mostly in precious metals, because I always had a feeling that these so-called experts were always misleading you. Now let's take a look at precious metals prices. Let's see what it's doing now. It's $12.55, still quite lower than several weeks ago. It was around $14.40. Silver is around $19.63. Let's take a look at where silver was earlier in the day. I was wondering if it touched. Yeah, we have struggled to pass over 20. Yeah, we touched 2001, but suddenly we couldn't make into a situation where we would go towards 2050 or something like that. So it looks like we kind of have a ceiling situation here. So tell me what you think. What do you see for the markets ahead? And please stay tuned for more. Thank you so much. And I will have more updates on real estate,